Home Depot just reported earnings today, and this came with a major warning about what's ahead for the U.S. economy.
Forecast is really the big news here. The company cut its comparable sales outlook for the year. Pros tell us that for the first time, their customers aren't just deferring because of higher financing costs, he said. They're deferring because of a greater sense of uncertainty in the economy.
There are two major retailers reporting earnings this week, and that is Walmart as well as Home Depot. And both of these companies are looked at as a major indicator of how consumers are feeling and whether or not they are out spending money. While we won't have Walmart's earnings report until Thursday, here's what we learned from Home Depot's earnings report this morning. Taking a look at their Q2 2024 earnings here, Home Depot reported solid results that slightly beat expectations. Earnings per share came in at $4.60 versus the consensus estimate of $4.49. And as far as sales go, revenue came in at $43.18 billion compared to expectations of just $43.06 billion. With earnings and sales that beat expectations, this would ordinarily be looked at as a very solid earnings report. However, it's what Home Depot expects as far as sales go for the second half of 2024 that has everyone worried. In this earnings report, Home Depot issued a warning about lower sales that are expected for the rest of the year. And the reasoning behind this is higher interest rates having a significant impact on home sales right now, but also, more importantly, a shift in the feelings of consumers. Now, as far as the specific numbers that were of concern here, it is the comparable sales figures that have been adjusted from the previous estimates earlier this year. Comparable sales looks at the total sales for the same stores across different periods of time. Since retailers like Home Depot are constantly opening new stores and possibly even closing some stores, this takes those factors out of the equation. Earlier this year, Home Depot issued an estimate that full-year comparable sales would be down about 1% in 2024. However, in this recent earnings report, they have adjusted this figure significantly. They now expect that full-year comparable sales will be down 3 to 4% compared to the same period in last year. Now, as far as why this is happening, Home Depot's CFO shared some details in an interview with CNBC. Specifically, the CFO referred to consumers being in a deferral mindset, which began in the middle of 2023. And above all else, he views this as being a result of the higher interest rate environment that we've been in for quite some time now. For one thing, going out and getting a home improvement loan or even a home equity line of credit is coming with significantly higher borrowing costs than it has been previously. So this is obviously dampening sales for home improvement stores, as that is where many people would go for materials for these projects. But in addition, the housing market is having a huge impact on home improvement sales too. With rates as high as they are right now, many people are putting off selling their home as they don't want to go out and buy a new home at a much higher interest rate. So instead of putting money into their homes right now to then sell it for top dollar, many consumers are just waiting on the sidelines to see what happens with interest rates. However, this is not the only factor that is significantly impacting sales for Home Depot and other retailers. The CFO also mentioned that surveys of customers and contractors in Q2 have revealed another significant headwind that they're facing. What they found by conducting these surveys is that home improvement professionals are finding that customers aren't just deferring projects due to higher financing costs, but they are also doing so over a sense of greater uncertainty in the economy. And this could be a big problem because that means that lower interest rates alone might not be enough to bring back consumer spending. Home Depot is one of the first major retailers to report earnings, and next week we're going to be getting earnings from Target, Macy's, as well as Best Buy. And if this becomes a trend across the board, weak consumer spending could become a significant problem for the overall U.S. economy. Keep in mind as well that the customer base for Home Depot is viewed as more financially stable compared to other major retailers out there. For the most part, those who are shopping at Home Depot either own a home themselves or they are working on a project for somebody else. Let's take a look at another important detail in this earnings report, and we're going to be revisiting comparable sales. For the second quarter of 2024, Home Depot reported a 3.3% decline across the entire business. and this became the 7th consecutive quarter of negative comparable sales for Home Depot, indicating that this is clearly a trend at this point in time. Home Depot and other home improvement stores benefited massively from the global pandemic. Not only were these stores allowed to remain open, but tons of people were pouring money into home improvement projects while they were working from home. In addition, the pandemic kicked off a major reshuffling across the United States, causing home prices to skyrocket. This, of course, led to many flippers entering the market, and a lot of them were buying their supplies right from Home Depot. But all of that has now come to an end, and the reality today seems to be a very cautious consumer. And keep in mind, all it takes for a recession to start is overall consumer uncertainty, which is very contagious, leading to less consumer spending. Home Depot isn't the only company warning about this consumer pullback either. McDonald's, Starbucks, and even Disney have also recently reported that consumers are spending less money. Now, it is very possible that sales for Home Depot will pick up once interest rates come down. And the Federal Reserve has stated that they could cut interest rates as soon as their September meeting if the inflation data supports this. And we're going to be getting fresh CPI data for the month of July tomorrow, so that will be very important to watch. If interest rates come down over the coming months, this could cause the overall housing market to thaw and transactions to pick back up again. With home prices as high as they still are currently, a lot of people would be looking to put money into the homes that they are selling in terms of improvements or maybe just a fresh coat of paint in order to get top dollar. In addition, lower interest rates would lead to lower borrowing costs for those looking to take on loans for home improvements. But if consumer sentiment has in fact changed, then interest rates might have little to no impact on overall spending. And if this trend of less spending continues, this could ultimately lead us towards a recession. Let me know what you think about this down in the comment section below. And if you made it to the very end of the video, be sure to drop a like on this. And if you want to see more current events videos like this, perhaps even a video on Walmart's earnings report later this week, make sure you subscribe and hit the bell for future notifications. You can click below to watch my latest video, and I hope to see you there.